Welcome back to the portfolio, everyone. And today I'm giving you my 5 top picks of stocks that you should look at during this little dip in the market we're having right now. So as always on this channel, I start off my videos by showing you my dividend portfolio, currently sitting at a value at $29,311, down overall 20% on the portfolio because of the dip we're having in the market over the past month, which is a dollar decrease or loss in value of $7,222. So I'm going to jump right into it. Today I got 5 different stock picks that I think you should take a look at, do your own research into, and maybe good investments into the stock market right now. These are all dividend paying companies who I believe are going to survive this little drought we're having in the market, and it's going to survive and thrive into the future for years and years to come. The first stock is actually an ETF that I'm going to show you. I'm a big fan of low-cost ETFs. I believe for most people who take a passive approach to investing, these are some of the best investments you can make. Of course, I'm not recommending anything to anyone. This is not financial advice. It's just my personal opinion, and I'm just sharing this with you for entertainment purposes, not any financial advice. But just to show you my first idea is VYM, Vanguard's High Dividend Yield ETF. I'm sure everyone knows what Vanguard is. They are one of the low-cost ETF producers in the world. My personal favorite, but that's just my opinion. VYM, I really like it for a bunch of different reasons. If these are all dividend-paying companies, and this is a high dividend yield ETF, currently yielding a nice 3.88%. If I show you some of the holdings, this ETF is filled with a very diversified portfolio of holdings. You can see here from the pie chart, their holdings are separated very nicely into a bunch of different sectors. And on the right here, you see the largest sectors are financials, healthcare, consumer, technology, utilities, and so on. So they're diversified into almost every different sector, all 11 sectors actually, even though real estate has a very tiny percent. And it's a high dividend yield ETF. Some of the top holdings are all household names that I love. These are JP Morgan Chase, Johnson & Johnson, Procter & Gamble, AT&T, Intel, Verizon, a lot of other many core holdings. These top 10 make up 27% of the entire portfolio, but what I love to see here is that this entire ETF holds 402 different companies. So you're extremely diversified. These are all American companies. And you have that nice dividend income coming in for 3.8%. And even if a couple of these companies cut their dividend, your entire dividend is not lost because this portfolio is so diversified into 400 different holdings. Moving over to the dividend itself, you can see here a nice 3.88% yield, annual payout of $2.74. And the very important thing I like to look at, and I'll look at for all the different holdings I show you today, is the 5-year dividend growth rate. I want the dividends to grow faster than inflation. Inflation is between 2 to 3% per year, and I want my dividends to grow at a faster rate. So for me personally, if I'm picking an individual company or an ETF, I need to see that dividend grow between 5 to 10% per year on average. So as you see here, VYM fits perfectly in that at 8.3% per year in annual dividend growth. As well, if you're looking for the Canadian equivalent of this, which is my largest holding in my portfolio, is VDY. Vanguard's High Dividend Yield ETF for Canada. So instead of VYM, VDY on the Toronto Stock Exchange. Moving over to pick number 2 is, of course, Pepsi, another one of my favorite holdings in any portfolio. So these stocks I'm listing with you right here, these are not speculative picks. These are companies that you should all know who pay strong dividends, who can sustain their dividend over the long next 10, 20 years with increasing their dividend each and every year. These are not those speculative picks where I think you're going to gain 50% in a month. These are those slow and steady blue chip companies that are going to be here today and in the next 10 years and 15, 20 years down the line, consistently paying that dividend. So as you can see here, Pepsi is in the consumer sector. As well, I tried to pick different stocks you'll see throughout this list that are in different sectors, so I'm not just tediously giving you companies that are all in the same sector. I like diversifying across different sectors. So Pepsi, in the consumer sector, of course, everyone knows what Pepsi does. They operate in soft drinks and a bunch of different snacks and food outlets and companies they own. Market cap of $166 billion with a nice yield at 3.18%. Moving over to their dividends. This is what I like to see too. As you see, I like dividend yields between 2 and 4%. So Pepsi with a nice yield at 3.18%. and payout ratio. So a sustainable payout ratio is very important when picking or looking into dividend paying companies. If their payout ratio is extremely high, which means they may not have the capital to actually increase their dividend each year, and their dividend may be in jeopardy in the future. So a threshold for me is I like having companies who have a dividend payout ratio at least below 70%. It's very rare that I pick companies that have above 70% payout ratio unless it's for a specific reason. That's a whole different video. I'll get into that. So you want a nice sustainable payout ratio, and Pepsi has that at about 65%. They have a 47-year dividend growth history. This is remarkable. They're almost going to be a dividend king. You become a dividend king at 50 years of increasing your dividends, and with an 8% 5-year average growth rate on their dividend. So they're increasing their dividend by a great amount each year, an average of 8% a year, which is fantastic, with a 47-year dividend growth history. What that shows is that they've gone through numerous recessions and they've come out on top. And not only during those recessions did they sustain their dividend, they actually continued to pay and increase their dividend during those recessions, which is amazing to see. So this company is one of those companies that you know is going to survive, continue to thrive, and continue to move forward into the future. So that's Pepsi. That was my first stock, but number 2 on my list. The number 3 holding I chose, Caterpillar Inc., ticker symbol CAT, of course traded on the New York Stock Exchange as well. This is an industrial company that I really like and I really believe has a strong sustainable dividend moving forward. A very large market cap at around $64 billion, nice 3.55% dividend, and a forward PE ratio of 15.4, and a forward earnings per share at $7.54. Moving over, of course, to the dividends, because that's what this video is focusing on. Of course, there's a bunch of different metrics you have to look at when researching these companies on your own after this video. I like showing you right to the dividends because I want to give you a short recap. I've looked into these companies a bit further when I was choosing this list, but I want to just focus on the dividends and the sustainability of these dividends moving forward, because right now with what's going on in the world, everyone would like to see that consistent cash flow coming in, and these picks that I have on this list, I believe are going to continue to pay their cash flow, even regardless of what happens throughout the world. So as you can see here, they have a dividend yield at 3.55% with a very nice 54-55% payout ratio. Of course, with a nice 7.77 5-year average dividend growth rate, which means, of course, once again, they're increasing their dividend a lot faster than the rate of inflation. And 26-year dividend growth history, which means that they are actually a dividend aristocrat. They've increased their dividend for more than 25 years in a row. And again, that just shows that they've been increasing their dividend through the past recessions. The past maybe three to four market issues that caused a large drop in the stock market, they've continued to not only pay their dividend, but increase it those years as well. So of course, this is one of my favorite picks, and this is in the industrial sector. So the first pick, Pepsi, was in the consumer sector. Moving on to Caterpillar, which operates in the industrial sector. As you see here on the 1-year chart, it was kind of flat on the 1-year chart at around $120, $130 a share. Then we saw this strong dip, and now we're back at $111 a share. So still, I'm not saying this is the bottom of the market. No one knows when that is. These are just solid holdings that you can add to your portfolio at any time that will pay those consistent dividends moving forward. Next, we got TD Bank. Of course, it's a bank, so it's in the financial sector. So now I'm changing up sectors once again. TD Bank is a very solid company that operates in both the US and Canada. Of course, it is Toronto Dominion Bank, so it is primarily traded on the Toronto Stock Exchange. It is a Canadian company, but they also generate 40% of their revenue from the United States. So I chose this bank for the financial sector because they have such diversified revenue streams. They have revenue coming from a large part coming from the United States, a large from Canada, and a small international revenue stream also. So they have a lot of revenues coming in from a lot of different sources. They're not only confined to one single market. Of course, very large market cap, $76 billion. Yield, a very nice yield, the highest yield on the list so far at 5.37%. PE ratio of only about 9. Forward earnings per share at $4.42. Moving on to the dividends card, $5.37% dividend yield, like I said, and it's very high because of this dip, but this company, I believe, has a very sustainable dividend history and dividend growth moving forward. So their payout ratio, once again, is at 51-52%, very sustainable. I love seeing companies that have a dividend payout ratio around 50%. 5-year dividend growth rate around 8% as well. So we're seeing a lot of different dividend increases that hit that threshold between 5 to 10% yearly dividend growth, with a lot more room to move forward in the future. This dividend growth is only 4 years, which is actually incorrect. Their dividend growth is about 8-9 years at the moment. TD Bank has actually never cut its dividend, but they did stop increasing it during the 2008-2009 financial crisis. They continued to pay out the same amount. They never missed a dividend payment, but they just didn't increase it for those 2-3 years at that time. So their dividend history goes up back over 130 years plus, but they haven't increased it each and every year, but they've never missed a payment. And with a sustainable payout ratio at around 50%, I don't think in the near future they will ever miss a payment as well. Moving on to number 5 on the list, Canadian National Railway. Of course, this is cross-listed on the Toronto Stock Exchange as well. Ticker symbol CNR on the TSX and ticker symbol CNI on the New York Stock Exchange. This is once again in the industrial sector, but it's a little different than what Caterpillar was. This is a railroad company. And what I like about this company is that this company is a necessity of the world. It's essentially an essential service. They transport so many goods across North America that I don't believe they're going anywhere anytime soon. If you look here, they have a $55 billion market cap, so again, a very large company. But this is actually the smallest yielding company out of my 5 list here, at only a 2.11% dividend yield. So once again, moving over to the dividends chart, you can see here that the yield is 2.11%, and I like dividend yields between 2 and 4%, as I've previously mentioned. So it is on the lower end of that yield, but once again, it meets the threshold, and I don't really chase dividend yield at the current moment because I look at dividend growth in the future, and that's what makes this company stand out. Very low payout ratio at around 40%, so they have a lot of room to continue to pay out that dividend and increase it for years to come. 5-year dividend growth rate at 12.5% per year. So they have a lot higher dividend growth rate, and they're increasing the dividend a lot faster than the previously 4 companies I've mentioned. Of course, Pepsi, CAT, TD, the VYM dividend ETF have been increasing the dividend between 7 to 8% a year, which is fantastic, which is exactly what you want to see from a blue chip company that's been around for a long time. But this one's a little different of a play. This company, CNI, Canadian National Railway, or CNR, has a 2.11% dividend, so a lower current yield, but they increase their dividend at a faster rate than those other 4 companies. They have a strong dividend growth history of 11 years. I believe it actually goes back a lot longer than that, with a nice annual payout at $1.64. So once again, this company I believe is going to continue to be here. Railways aren't going anywhere anytime soon, and no matter what happens with the current economy and what's going on right this way, all the railroads installed across North America are not going to get removed within a month. This company is going to continue to operate, it's going to continue to thrive, and continue to grow revenues throughout the history, throughout the next 10, 15 years, and as it has done throughout its history. And I didn't show you anything about the price chart for any of the other 5 companies because that wasn't my primary concern with those companies. But I will show you it with CNI because this company, of course, they have the little low 2% dividend, but this company is also a growth company along with the dividend. As you can see here, the share price has a solid upward trend throughout the past 10 years. Of course, this was a 10-year bull market, but even if I move over to the max chart, what you see here, all the way back to 1996, a continuous strong uphill trend. So this is not only a dividend play, this is also a growth play. So I want to change it up a little bit and have one of those plays in here for you. And just going to end this video off by going back to the portfolio and saying, as always, thank you for watching. Those are my top 5 dividend picks that I think everyone should do a little more research in and maybe pick up into this little dip that we're having right now in the market. I hope you appreciate it. I'll see you next time.